You've seen this movie before, haven't you? It's Target, the sequel. Equity futures negative. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Live from New York City, we begin with the big issue, profit margins taking center stage.
There's so many pressures on margins.
Businesses feeling the pressure of lower margins.
The market needs to price in a change in the profits outlook.
Who's able to hold on to margins?
Listen to the CEOs.
Listen to what CEOs are saying in their earnings calls. They're very cautious.
It's a long list of companies that are freezing hiring and or cutting staff.
You're seeing all these CEOs, their confidence is waning.
You're going to see some downward revisions.
I mean, you saw the targets of the world. I mean, the stock was absolutely crushed.
They can't push this inflation in their base prices onto consumers.
Those tail risks are still really elevated.
There's a long list of risks surrounding this market.
You have to look at those and think that the sharks are circling a little bit.
Katie Lyons, I'm pretty sure I watched this movie play out 3 weeks ago.
Yeah, this is happening in rapid succession, John. A really negative surprise for Target just 3 weeks ago, followed by the second cut to its profit outlook today. So a stock already down 31% year to date is lower by another 7% in pre-market trading this morning, as it now says that its operating margins for the second quarter will be around 2%. That is down from the previous guidance of a range around 5.3%. Now, I will say they do think this gets better in the second half. Somehow they expect operating margin will rise to about 6% in that later period, but clearly investors have some doubts about that this morning. The problem for Target, John, is that demand is shifting rapidly in the face of inflation towards things like staples and away from discretionary categories. And the company finds itself with way too much inventory for items that consumers no longer want. Now, how does it solve that? It says it's going to try to cancel orders, cut down on those, and mark down more for excess merchandise. So basically discounting is coming. Things are going on sale, John, and obviously that means less profit. Target also says it plans to take other actions like adding storage near ports and adjusting prices to offset high transportation and fuel costs. But as we've seen from some retailers, the ability to exercise that pricing power and pass those costs on, getting more difficult as a consumer becomes less tolerant of higher prices. And of course, Target isn't the only retailer grappling with inventory issues either. We've seen buildups really across the board to the tune of 30 to 40% for the likes of Walmart, Home Depot, TJ Maxx, you name it. And of course, it raises a question as to whether some of these players too will also have to start discounting in order to get those inventory levels down. Although one analyst, John Zolidis, president of Quo Vadis Capital, saying this morning that this seems to be an internal Target issue, that this is a company that has just grossly mismanaged its inventory, John.
Kelly, that's the number one issue for a lot of people. Is there a broader macro signal here? Or is this just about a single name? And Katie, you mentioned one word twice, discounts, markdowns. This is not going to be an inflationary story. This isn't about passing on higher costs because of higher costs. This is different.
It is different. You're trying to get the consumer to buy these discretionary items that Target now has a lot of, that as a consumer faces higher prices for groceries, gas, maybe they're less willing to go out and buy that television, John. And for Target, a discount retailer that caters to the lower end, it might mean having to meet them where they are.
The stock is down 7%. Kelly, thank you. Joining us now is Nuveen's Tony Rodriguez, Zach Griffiths of Wells Fargo. Zach, first to you, how difficult is it to take a macro signal from this name here, from Target, and from other retailers in America too?
It's tough because it's a story that we heard once and we're hearing again, as you outlined at the start here, John. And to us, perhaps these markdowns become a bigger part of the story from an inflation perspective, from a more macro perspective over the next couple of months, but we're really not seeing it right now. And when we think about what we expect for inflation on Friday, which is certainly key for the monetary policy outlook, we expect inflation to show that it is not coming down slowly. So it's kind of tough to square the message from Target with what we're seeing and expecting from the macroeconomic data, but it's definitely something we'll be keeping an eye on going forward.
But Tony, when you look at this, is this a change in the strength of the consumer or just a change in the spend, a change in the basket and what goes into it?
Well, good morning, Jonathan. Good to be with you. And I think it's actually a combination of both. I think the bigger portion is the change in spend, as we are now kind of much more reopening is occurring and people are shifting from goods to more experiences, services. I think that's the biggest read through. But I think part of it is also just a lower amount of spending given the higher prices that we're seeing across the board, but especially in areas that really hit the pocketbook quite a bit, whether it's in energy prices, food prices, et cetera. But I think you saw that, for example, also in housing. You've seen some decline in housing activities as a result of higher rates, Fed activity, et cetera. So I think it's a little bit of both that is the read through for the broader economy.
Tony, this is the composition conversation. Let's have the conversation about speed. It's only 3 weeks ago they did the same thing. It seems to me that a lot of corporations, and not just retailers, across industries, Tony, are really, really struggling to get a read on demand in this economy, where it is and what that demand is for. What do you make of that?
Well, I think it's partly what the Fed is hoping to achieve here, and that is a decline in aggregate demand. They clearly are looking at inflation that is well exceeding any levels that they're comfortable with. The tool that they have to battle that is not one that can affect the supply chain, is not one that can affect energy prices, but it can affect aggregate demand. So as they are, started on the rate hike cycle, but the market has fully priced in a substantial amount of rate hikes, you're seeing that impact on aggregate demand. So I think that the bottom line is we expect a slowing in the economy as we move through the year. This is one example of how you start to see that play through in companies, retail here being the example.
Zach, you've got a different view on this. You think inflation can persist and yields can go higher. Walk us through it.
Yeah, Jonathan, everything that we're seeing, at least in the macroeconomic data, suggests that inflation is very broad-based, and you are getting additional difficulty from the energy side of things, which will be more of a near-term story. But to us, it just shows that the Fed is going to have to go more aggressively than the market is priced for. And when we think about where the market is from a terminal rate perspective, it looks to be around 3.25 in June of next year, give or take. We think that's way too low. Something like 3.75 to 4% is what the Fed is going to need to do to really bring down this inflation that we expect to be very persistent. And so we expect the market to converge on this view over the next 2 or 3 months as we see these inflation prints really get stuck around 8% from a headline perspective. And that's just not a situation that we think lends itself to the Fed slowing down, stopping and looking around. None of that. We think they have to keep going 50 basis points at least through September, and that's going to flatten the curve and raise rates across the curve, but driven more by the front end for sure.
Zach, you said two big things there. We get stuck at 8%. The Fed's got more work to do. Fed funds gets closer to 4 and away from 3. Run me through the Treasury market. You talked me through the shape of the curve. I want to talk about levels. Where are we going through the front end out to the long end?
So we think the 2-year yield could hit 350 by the end of this year. And when we think about the back end of the curve, we see supply and demand dynamics, at least in the near term, not lending itself to such a big rise. So let's call it 325 on the 10-year. If you want a midpoint, I'd say the ranges around those midpoints are pretty wide, as there is still a lot of uncertainty in the outlook. But that's how we see things unfolding if our call for inflation to remain persistently around this 8% number is correct.
Tony, what's the counterpoint to that? Getting stuck at 8?
Yeah, so our view is that, we're not that far off on a 10-year forecast where we think kind of a 275 to 3.25 is a range for the end of the year. We'd put a point estimate at 3%, but we don't think the front end gets quite that high because we do think the Fed will be able to back off. Some of the things that we're seeing with respect to inflation, which is the one factor model that the Fed is using right now, is that we are seeing, for example, some improvement in the ISM when you look at some of the supplier deliveries and backlogs, for example. And one of the key things is average hourly earnings. And you saw that come in at 0.3% last month. But if you look at a 4-month annualized, back in January, that was 6.3%. And we look at it today, that's down to 3.8%. So we're already seeing some softening in the wage pressures. And again, it's way too early to call it mission accomplished. But we do think that as we move closer to the fall, the Fed may be able to back off from these 50 basis point hikes to a 25 basis point hike cycle. And that will prevent the 2-year from, we think, reaching that 3.5% or higher level.
Tony, that's the hope. A lot of people share that hope. I hope you're right. I hope that we can get to that soft landing and the economy is going to be okay. When it comes to risk assets, I don't have a view. I'm going to ask this of you, though, Zach. Can you make the case for risk assets if we haven't seen the high in yield to the Treasury market?
It's certainly a difficult backdrop for risk assets to perform well if yields are going to continue rising. And when we think about what the big driver of the increase in yields will be. It'll be on the real yield side of things as the Fed tightens policy more aggressively and the market starts to price in a more aggressive Fed. So that is a difficult backdrop for risk assets in our view, as it signals a tightening of financial conditions. I think that the U.S. consumer and the manufacturing sector has shown some bright spots more recently, and it's tough to juggle these different data points, whether it be from a micro perspective from earnings or these more macroeconomic data factors. But to us, we think that the consumer can hang in there. And when we think about economic growth over the next couple of quarters, it's going to remain at or above potential. And that's just not a situation where the Fed can slow down. So that's definitely going to create a difficult backdrop for risk assets over the next 6 months, let's say.
Zach and Tony, sticking with us. Your equity market looks like this. 20 minutes out from the opening bell, equity futures down about 1% on the S&P, on the Nasdaq 100 down by 1.3. Abby, it's all about one name, isn't it? It's been about Target for the last few hours.
It is certainly all about Target. Shares down sharply, and it really feels like Groundhog's Day, to the point that you and Kaylee were making earlier from just 3 weeks ago, because this is the second time that they have slashed profits and operating margins for the second quarter in about 3 weeks. They're now expecting that operating margin at about 2% for the second quarter. The average analyst above 6% for the second quarter. So just too much inventory, that bloating. This means profits down, of course. And the stock now set to open down about 45% from last year's peak. Really very brutal. It's weighing on other names, too. Now, the big question that you both were talking about, is this a macro issue or retail specific? It seems a mixture of both. Macy's has talked about a little bit of bloated inventory relative to pandemic attire. They were caught off guard by the desire for going out type clothing. That stock down 2.4%. Walmart, of course, a couple weeks ago, a very similar situation to Target, where their last quarter was pretty good, but the outlook relative to operating margins not great because of rising inventories. Best Buy down 4%. But, John, there is one bright spot. And, of course, Kohl's also reported a brutal inventory, but that stock up 8%. This on the news that they are in exclusive talks with Franchise Group over an $8 billion bid. They have 3 weeks to work out the details, but with that stock soaring up about 20% after its disastrous quarter bottom, it seems as though investors, traders, optimistic maybe it happens.
Abby, thank you. This Target story is really complex, really difficult to get your head around because things have changed so much in just 3 weeks. It's the second profit cut, profit outlook cut. For anyone looking at this particular name right now, are we writing down the current quarter? For them we are. Or are we writing down the whole year because we don't have confidence in their guidance for the second half as they forecast an improvement as this year continues? For now, at least, Target's down 7.5% following a big drop in the last month. Coming up, a host of primaries putting the spotlight on the midterms.
We understand that prices, these gas prices, including food prices in particular, this is hurting families, especially as they sit around their kitchen table. But we're going to continue to do everything that we can.
The White House continues the fight against surging prices. That conversation up next.
We understand that prices, these gas prices, including food prices in particular, this is hurting families, especially as they sit around their kitchen table. But we're going to continue to do everything that we can. The rescue plan has really been able to help us put us in an economic place where we're stronger.
Paying at the pump, we have a new number, $4.90. The average gas price in America getting closer to $5 a gallon. Drivers in California, they're looking at a 6 handle. This building the pressure, keeping the pressure on President Biden with the primaries kicking off in 7 states. With us now, Emily Wilkins and Mike McKee. Emily, first to you, how big is this story? Inflation, price pressure, food, energy, and all the rest.
John, this is the story of the November midterm elections right now. And while the primaries that we see today, we're going to learn a little bit more about the direction that individual parties are going within the primaries. The overall story for November is very much inflation. And you see that in how the White House talks about it. You see it in how Democrats talk about it. And you sort of see that they do try to change the narrative a little bit. They try to not talk about inflation, but talk about unemployment, not talk about inflation, but talk about lowering prices. And the reality is that there's really only so much that the Biden administration and Democrats can do to get these prices down. But it's very much impacting Americans, and it's giving Republicans a lot of confidence in a midterms year where they were already expected to come out ahead. This is just the wind at their backs at this point.
Mike, this conversation, at a time when we're actually looking at Target selling down inventory, marking things down. Put those two things together for us, Mike. You've got this big inventory build-up for some of the retailers. They're going to have to aggressively sell some of these goods now at a discount. Then at the same time, you've got energy prices pushing ever higher, day after day, week after week, month after month.
And we've got CPI coming out on Friday, and the good news for Jay Powell is those sorts of things are bringing down core inflation. We're expecting it now to have a 5 handle, come down from 6, and that would be the Fed's target, what they're trying to get to. But the bad news for Joe Biden is Mr. and Mrs. America don't really care. What they're caring about right now is food and gasoline prices. And food prices, can't do anything about that. You got to talk to the weatherman, and you got to talk to Vladimir Putin about bringing down food. And look at what's happening with gasoline. We saw a brief drop down in April as gasoline prices flattened out. What's happened since then? You can see the yellow line. It's going to be bad on Friday. Headline is going to be bad news for the White House. Now, the reasoning behind this, and where Joe Biden gets treated a little unfairly, is that we don't have the gasoline refining capacity. They can get all the oil they want from Saudi Arabia or from the Strategic Petroleum Reserve. But right now, our gasoline refining capacity has dropped significantly. A lot of plants mothballed during the COVID crisis because everybody thought we'd be switching to renewables. And that means production of gasoline is down, supply and demand. There is less supply, demand still strong, prices keep rising.
Mike McKee, Emily, thank you to you both. It's painful and it could get worse. Goldman Sachs yesterday evening putting out this research note. Jeff Curry and the team with these numbers. Just listen to these numbers. 140 over 3 months for Brent. That's their 3-month price target. For WTI, 137. And even if you go out 12 months, they're looking at 130 on Brent. They're looking at 125 on WTI. Tony Rodriguez, Zach Griffiths back with us. Tony, are you modeling those kind of numbers? 140 over the next 3 months, 137 on WTI?
Well, we don't think that that's going to be an equilibrium level for oil prices, but we certainly think there's some ability for oil prices to hit that level over the next couple of months, given all of the volatility and uncertainty in the energy markets right now. As a longer term measure, no, we're thinking that we're going to be in this, kind of triple digit, but low triple digits, call it 100 to 120 for the average for the balance of the year. But then next year moving into a lower level than that, maybe getting back to below 100. So not modeling the 140, 150 for any extended period of time.
Zach, does that smell like demand destruction to you?
Yeah, that's going to be a big issue, I'd say, and we don't have that priced into our outlook for inflation. We think that oil generally comes down gradually from the levels that we're at today, so that's definitely at odds with us. And to me, it bodes the question, would the Fed look through that and its impact on the broader inflation measures, the headline inflation measures, I should say? Perhaps they do, but to me, it kind of just spells more issues, not only for the Fed, but for the U.S. economy if that were to come to pass.
Zach, how would you characterize the current relationship between what happens in the commodity market and what's happening with treasuries?
It's certainly an interesting dynamic to keep an eye on. And when we think about sort of what's been going on with how yields have risen, you've seen a lot more of a pickup in real yields recently. And if we do see these oil prices start to come up, we could see break evens start to rise again, maybe even back towards the highs of what we saw earlier this year. So that's definitely a dynamic we're going to keep an eye on. The Fed does not want to see break evens come back up. They've already bounced a fair bit, at least on the 10-year break even. The Fed would much rather see that come down and see that inflation expectations are starting to respond to their policy actions. So if you have that water muddied by a big increase, even from where we are today in energy prices, that's just going to be more of a headache for the Fed.
140, 137 on Brent on WTI. These are big forecasts. Brent crude right now 119, WTI 118. Tony, when you think about where you want to be in credit and where you don't want to be in credit, how much does the energy story influence that?
Certainly from a sector composition of your credit exposure, it influences. We have been relatively positive on the energy space, materials this year. So having overweights to that makes sense in the context of these energy prices. If you start modeling in 150, then I think both the demand destruction that might come from that and the Fed policy response, which would mean a certainly higher ultimate level of the Fed funds rate and the aggregate demand destruction that would bring along, I think that has to temper your view on where to position from an overall credit perspective.
Zach, it's almost like a double tightening, isn't it? Crude goes higher, it hurts the consumer. Crude goes higher, and this Fed has to go higher too. At some point, does this Federal Reserve have to start responding to what happens with the output numbers, even if inflation persists? Zach, let's talk about your world and finish there. You think that this 8 number, we get stuck there. But what happens if the economy starts rolling over with that 8 number still sticky? What does this Fed do, Zach? Do you understand the reaction function of this Fed if that's the scenario they face?
Everything they've indicated up to this point is inflation is the #1 priority, and I just don't think they're in a position to respond to growth concerns proactively or even that quickly reactively if we do get these inflation numbers like we're looking for. So the Fed's in a very tough spot, but at the end of the day, if they aren't really seeing any material progress with inflation moving downward, I think that is what they're going to remain focused on, and perhaps it means a recession is necessary to bring this inflation down. That's not an outcome that anyone wants, but I think the Fed is probably at this point willing to risk that in order to get the inflation situation under control, as opposed to responding more proactively to a slowdown in growth or perhaps even a big hit to risk assets. So it's a tough spot, but we do think inflation is #1. The Fed keeps tightening, and it's a difficult backdrop for the U.S. economy and certainly for assets.
That's the scenario that Deutsche Bank are forecasting. A messy one, a recession ultimately by year end next year. Zach, wonderful to catch up, buddy. Zach Griffiths, Tony Rodriguez breaking down the bond market for you and the equity market too, as we get some numbers from Target once again. A familiar story. Futures down by 1% on the S&P, on the Nasdaq down by 1.29. Coming up the morning calls and later, Wall Street divided on the bear market rally debate. BlackRock's Kate Moore will chime in, and we will hear from the World Bank President David Malpass. That's coming up shortly. This is Bloomberg. 5 minutes away from the opening bell this morning. Good morning to you. Target is lower by almost 8%. Equity futures down 2. We're off by 1% on the S&P, down by 1.25% on the Nasdaq 100. That's the price action. Here are your morning calls. First up, Evercore upgrading ExxonMobil to outperform, highlighting the stock's compelling valuation and impressive earnings growth. Your second call from Jefferies, upgrading Peabody Energy to buy, expecting shares to outperform as China recovers and demand picks back up. And finally, Morgan Stanley cutting its Avis budget price target to 156, pointing to continuing recession risks and secular headwinds. That stock is down by about 3%. Coming up, BlackRock's Kate Moore says to remain defensive, with growth stocks starting to look just a little bit more attractive. That conversation up next, with futures down 1%. This is Bloomberg. If in doubt, blame Target. You did that 3 weeks ago. You can do it again this morning to a certain degree. Equity futures are down by 0.9% on the S&P. On the Nasdaq 100, down a little more than 1 full percentage point. Target is going to be a whole lot lower at the opening bell, maybe just not as low as it was 3 weeks ago. Another cut to the profit outlook. Switch up the board. There's your opening bell in the bond market. We look a little something like this. Yields lower by 3 or 4 basis points on a 10-year, still just about holding on to 3% on a 10-year. In the FX market, euro dollar 1-0 and all the sixes out of the ECB on Thursday for President Lagarde. New York crude WTI 118.22. We are negative 0.2% with a big call coming from Goldman to have a little look at 140 later in the third quarter. Big headline crossing the Bloomberg too. Let's get to Mike McKee for a report from the World Bank. Morning, Mike.
Morning, John. Well, speaking of cutting, the World Bank cutting its global growth forecast. This would be a man bites dog or dog bites man headline, except that it's more gloomy than we anticipated. 2.9% is their forecast now for global growth. There's no accepted definition of what a global recession is, but as they say, that's close enough for government work, 2.9%. And they give us a stark warning that stagflation is on its way, low growth and high inflation will be around for a couple of years. Talk more about all the details in just a few moments, John, but a gloomy outlook from the World Bank.
Hey, Mike, looking forward to it because we'll catch up with David Malpass, the World Bank president, in around about 10 or 15 minutes' time. Mike McKee, thank you. One stock to look at, its Target. We're down about 7.4% in early trading. Let's get to Abby for more. Morning, Abby.
Good morning, John. Yes, we have Target plunging down more than 7%. Right now, the stock at its lowest level since September of 2020. And this, of course, after the company slashes its profit outlook and its operating margins for the second quarter. Once again, the second time in 3 weeks. It's like Groundhog's Day. So Target down about 7%, weighing on the other retailers. Walmart, Macy's, and Wayfair all down sharply, too, as it's a fear that it could be not just a Target problem, that inventories are bloated at a number of retailers and as folks spend more money on experiences. And of course, relative to those operating margins, the company now looking for a 2% operating margin in the second quarter. That is the current quarter. The average analyst closer to 6.6%. Now, they do expect a little bit of a recovery later this year toward a 6% operating margin. They also expect the fiscal year revenue growth to stay in the low to mid single digit range. So a bit of a mixed picture here. It really seems like a true operating problem as opposed to customers so much. But it's pretty clear, John, that if they slash the operating margin to 2%, they have the ability to discount in a big way to make the items look attractive. The stock, as we were just looking at, also on sale, down sharply, down more than 30% since its fiscal first quarter was reported. The question is, when will investors want to buy? That'll come down to the E in the PE when it stops falling.
I should point out again and repeatedly, we did this 3 weeks ago. We're doing it again this morning. Abby, thank you. About 2 or 3 minutes into the session, this is what we look like. The S&P down 1%, energy outperforming up 0.2%, information technology together with consumer discretionary underperforming, IT down about 1.2%. Taylor Riggs, some of these big tech names facing a familiar problem. Higher yields, and that's the story of the last week.
Indeed. So today, of course, that story reverses. We're back below 3% on the 10-year, but you're totally right in terms of the long-term trend has been the path to yields higher. Ian Leon over at BMO Capital Markets yesterday saying that look for more cheapening, especially when we're getting some supply this week as well, particularly on the long end. So with yields higher and some of the cheapening, a bond price lower, that certainly means more volatility within the tech space. That's what you're seeing there, John. It was pretty incredible. We've gotten used to a lot of this volatility, but you've done now almost 3% swings from the peak of yesterday, big gains higher into some of the sort of losses today when we take a look at the NASDAQ 100. And the futures and sort of that intraday price action. If there is any good news out of this, it's sort of a re-evaluation of some of these valuations, how we're thinking about valuing these companies. As you can see there, we're actually sort of back to where we were pre-COVID. So sort of leading to a lot of people saying, have we taken a lot of the froth out of the market? Gina Martin Adams out of BI, huge note this morning, fair value on the S&P looks at around 4,100 or so. When you think about really sort of the forward PE ratios of all of these companies, John, as you mentioned, though, when we think about froth and sort of pulling out of this market, $3 trillion year to date has been wiped out so far this year. Take a look at this. And it's all the big companies, Apple, Microsoft, Amazon, just really seeing a lot of that market cap coming out.
Absolutely brutal. Taylor, awesome as always. Look out for Taylor's coverage at the close a little bit later with Remain and Caroline Hyde as the market close wraps up. The open just underway, a couple of minutes in, call it 4. And no real drama on Twitter this morning. We're down just 1/3 of 1% to 39.44 as Elon Musk is threatening to walk away from his $44 billion deal. Back with us. Let's get to Ed for a little bit more. Morning, Ed.
Yeah, morning, Ed. A more modest decline, but still the spread widening right between $54.20 offer price and the current share price. Interesting reporting on the Bloomberg terminal from Kurt Wagner. There's no such thing as buyer's remorse. We always say on this program, we don't know what's inside the head of Elon Musk, but we do know what Twitter's board thinks. They've said in the last 24 hours they intend to hold Elon Musk to the terms of the agreement reached on April 25th, which is $54.20 a share, valuing Twitter at $44 billion. That's a phenomenal deal when you take into account the sell-off in tech stocks that we've seen this year. You just discussed that with Taylor. Another piece of reporting on the Bloomberg terminal overnight, John, the Texas Attorney General has opened an investigation into Twitter, looking into whether they're misleading the public over the proportion of users on the platform that are bots. Interesting.
Ed, this is turning into a mess for both sides at the moment, that's for sure. Ed Ludlow, thank you, buddy. As always, that stock basically unchanged. Let's get to the bigger debate of the last couple of weeks. We've seen a squeeze in the stock market. We're off the lows. Is it a bear market rally? or the start of a new bull phase? Strategists continuing to weigh in on the debate, with strategists running the following. One of the more difficult calls in this business is differentiating between a bounce in a downward trend versus the start of something more durable. Our best guess remains the rally is more the former than the latter. Let's get to Kaylee for more. Hey, Kaylee.
Hey, John. Well, Chris Ferro, who heads up technical analysis over there, is pointing to momentum as his reason why. He says typically when you see a significant market bottom, there's a lot more stocks trading above their 50-day moving average in the S&P 500. That usually that percentage number blows out to something in the realm of 80 to nearly 100%. We have not seen that yet. As of this moment, only about 41% of stocks in the S&P are actually trading above that technical level. So he says that raises doubts about whether this uptrend can actually last. Because yes, the S&P 500 has recovered some ground after narrowly avoiding falling into a bear market just a few weeks ago, but still the index is down more than 14% from its record high in the first couple of trading days of this year. And we know that there are plenty who think that this still has further to go. The loudest voice being Mike Wilson over at Morgan Stanley, who's warning about earnings, saying by the time we get through the second quarter earnings season, when we're in mid-August, this index could be down around 3,400. And Bank of America's Michael Hartnett also is in the camp that this is just a bear market rally, saying he would short the S&P above 4,400. Meanwhile, JP Morgan in the more bullish camp, saying the fundamental risk reward for equities is likely improving as we see peak Fed hawkishness and peak dollar strength. And overall, strategists are still leaning on the bullish side. The median year-end target for the S&P 500, 4,800, John, though it's worth noting there is a 35% spread between the lowest and highest targets. So that really just speaks to the division out there on the street right now, John.
Big time. Well illustrated. Kelly Lyons, thank you. Thank you very much. Here's the take from BlackRock. Here's the quote. Defensive positioning and capital preservation will dominate in the near term. A list of hurdles needs to be cleared before aggressively adding to risk, but mispriced companies are increasingly harder to ignore. Pleased to say that waiting patiently is Kate Moore of BlackRock. Kate, let's borrow that language from strategists, that decision. Is it a bounce in a downtrend or the start of something more durable? Which one is it?
Yeah, I'm going to agree with strategists, actually, John, and say it's pretty difficult to identify at this point. The one thing I'm really focused on, though, and this is where, like, figuring out exactly the direction over the next couple months becomes increasingly difficult, is that this lack of conviction across investors. We've had, as you mentioned just a moment ago, kind of weaker breadth. There seems to be across all of the investing segments, a lack of strong conviction in the direction of the market, going into September. Now, next year, I think people are going to be more optimistic, but we're not really fully pricing in 2023 at this point. So I think I'm not going to call it a buyer's strike, but I think we're going to see a lot more investors remain on the sidelines, remain cautiously positioned. And that actually may lead to some interesting opportunities for longer term investors.
Okay, let's talk about those opportunities. You've got three themes. I want to start with this one. It's timely. The consumer and the rotation from goods back to services. Is Target evidence of that happening right now?
Yeah, I mean, I think that's going to be a really interesting thing to watch, not just in Target, but across the entire competitive group there. I agree that everyone's extrapolating Target's experience to their peer group and then perhaps to the entire retail industry. The silver lining of this, and I know this has been discussed a little this morning, might be that goods prices actually see some disinflationary pressure as a result. And that would be, on balance, pretty good for the consumer. But as we've talked about a lot, we're seeing this rotation from goods consumption to experience and services spending. I think that is a very durable trend through the entire rest of 2022. And so maybe that's a little where I'm focused on the pricing side. I'm not worried about the health of the U.S. consumer. I think this rotation is clear and makes sense coming out of the pandemic. But we do want to be conscious of where the opportunities are from an earnings perspective. And if those retailers have bloated inventories and we're seeing this rotation in terms of spending, then I think we need to be thoughtful about where we're putting our money to work.
Okay, energy, another story for you as well. That's another favourable, durable trend you expect to persist because of what you say the supply-demand backdrop is going to support natural resources. The numbers out of Goldman, Kate, are unreal. 140, a 3-month price target on Brent. WTI at 137, and even 12 months out, they're looking at 130 and 125 respectively. Do I want to play that still through the energy names, even after they've ripped as much as they have, Kate, this year?
Yeah, look, we firmly believe there's still upside in energy and resources. Of course, it's going to be volatile. Of course, we're going to see some bounces. And of course, the bear debate here is whether or not slower global growth will take some of the demand pressure off resources. But it's been the supply side that really led us into this investment to begin with. In the fund, we had started adding exposure to energy and resources over the course of 2021. Of course, we continue to add through the beginning of part of this year. And now energy and materials are significant overweights for us. Look, we think even in a slower economic growth environment, the supply discipline, both from sort of industrial metals and miners, as well as on the energy side, really supports elevated prices for the medium term. And many of these companies are trading at really discount valuations to the rest of the market. And I think we can still get significant upside from here.
Okay, the last one in your three themes. This is the one where I really need some help. You say the secular trend of digital spending and transformation across industries. Now, typically when people hear that, they'll be thinking some of these tech names that did well in the pandemic and they're really struggling now. What do you mean by this? Can we get some more detail on where to look for that theme?
Yeah, when I talk to people about technology and I say, hey, I still see a huge amount of potential upside over the medium term, you know, sometimes people say, well, what about these big mega caps that really outperformed the market over the course of the pandemic? Isn't their story over? And I say there's a lot more to technology enablement, and to this digital transformation outside of the top 4 or 5 names. In fact, it's more around software and enterprise spend. We've talked a lot about security software over the last year or two, that I think we're going to see very durable investment across all industries. So I would tell investors to take a look below the mega caps and take a really strong look at where demand and spending will be. And I think they'll find that, you know, even though multiples have come down, the revenue and growth story, you know, remains intact. You know, these are places that most CFOs, most CTOs, and most, you know, management teams will not cut their spending. These are kind of durable and resilient areas, I think. And so I think we have some interesting valuations and good long-term durable growth.
Kate, a clinic, as always. Wonderful to catch up. Kate Moore there of BlackRock, breaking down the three themes she's looking at. This is what we're looking at right now. About 13 minutes into the session, the equity market down 0.6% off the lows. Speaking of off the lows, Target now down about 5%. Just as the session grows older, things get a little bit better for that name after the second cut to the profit outlook in just 3 weeks. Coming up, the world feeling the effects of rising inflation and slowing growth.
Economic dislocations, whether it's a recession or a depression, leave lasting scars. They leave lasting scars on balance sheets. They leave lasting scars on people.
That conversation up next with the World Bank President, David Malpass.
Economic dislocations, whether it's a recession or a depression, leave lasting scars. They leave lasting scars on balance sheets. They leave lasting scars on people. When you talk about the consumer, you got to ask who's got the wherewithal to withstand a slow patch in the economy.
The World Bank has a warning. Here it is. Here's the quote from their latest report. The world economy is again in danger, facing high inflation and slow growth at the same time. Even if a global recession is averted, the pain of stagflation could persist for several years. Mike McKee joins us right now. Hey, Mike.
Good morning, John. Well, it is stagflation in the forecast from the World Bank. That is low growth, high inflation, and they say it could last for years. They predict that global growth will just reach 2.9% this year, which, if you ask any international economist, comes very close to the idea of a global recession. Now, take a look at what's happening in individual countries. Almost all of the developed nations have seen their growth forecasts cut in half by the World Bank. The U.S. goes down to 2.5% from 5.7% coming into the year. China, 4.3%. Interesting question for David Malpass. With COVID still hanging around there, can they even make 4.3%?
Yeah.
Euro area cut in half. And here's the sad part. We've talked a lot about the destruction that Vladimir Putin has brought to the world economy, not just his own. And we've talked a lot about Russia, down 8.9% this year. The Ukrainian economy now forecast to contract 45%. because of Russia's invasion.
Mike McKee, that is utterly depressing. Mike, thank you. Let's speak to the man himself, David Malpass, the president of the World Bank. David, fantastic to catch up with you, sir. Let's start with this. Mike touched on it. How would you define a global economic recession, and is this it?
Hi, Jonathan and Mike. This is many countries will have a hard time avoiding a recession. We're not in. It's not a global recession yet. It could. The downside risk is that it could be a global recession. One of the key variables is whether supply comes back online in order to add growth and slow down the inflation rate. But this is the sharpest slowdown in 80 years. That's from the 2021 rate, which was high because of the recovery from COVID, to what we're looking at now, 2.9% in 2022. That's a very sharp slowdown, and it's really hitting the poorer countries hard.
David, what's interesting about this report is there is a temporary attitude to the conversation on Wall Street. I have them every day. You listen to some of them, I'm sure. When we have these conversations, we talk about maybe lasting 6 months. You go into 2023, things change. The essence of this, at the epicenter of it, is a dynamic that lasts for years. David, this stagflationary story could last for years. Is that really the case for you? And over what regions? Is this a global story or more concentrated for emerging markets and developing economies?
It's global, but it particularly hits the developing countries. There's a lot of inequality in the world. So the advanced economies, and particularly the people at the top in the advanced economies, have done very well over the last decade. So the reason that this is a prolonged risk for the world is that we're coming off of a very exceptionally low period of interest rates. Last year I called it uncharted territory on both fiscal policy, which was massively expansionary, and the monetary policy. So we're coming off of that. And you also have demographics, which are gradually slowing down in the world, fewer people coming into the labor force. And so that's part of it. And then this core problem of lack of supply and the supply chains not being repaired. One thing I'll add to this is energy is at the core of a lot of the supply. It's what makes fertilizer. It's what makes electricity. And there's as Russia is excluded from this, it means there's a big shortfall of energy, and it's not being made up for by new supply.
David, as you've pointed out and we've talked about, we're going to see a massive wealth transfer from the commodity importers to the commodity exporters. Within that, we're going to get some financial imbalances. Now, David, if I was doing this at the consumer level, if a consumer faced tough times, I'd be worried about a loan shark, if you will. Who is that loan shark on the international stage? And I know previously, in previous years, you've been worried about China and some of the loans they've made and the conditions around those loans that have been made to some of the economies that you focus on. Are you more worried about that now with this playing out?
China was the biggest lender during this expansion of the world, lending into countries, both poor and middle income countries. So one of the concerns right now is our data shows that it's 60% of the countries are either in debt distress now or at high risk of debt distress. That's for the 75 poorest countries, the IDA countries of the world. 60% are in debt distress, and with a big chunk of that debt owed to China. So we really need to find ways to restructure the debt and have it be more transparent. You know, the contracts have been written in recent years with collateral clauses, with non-disclosure clauses, and so the countries. It's hard to engage the conversation. So we've really worked with China to have them engage in the conversation to do the debt restructurings for the countries that need it. Right now, though, the distress is spreading to the middle income countries. And I want to come back to the first point, Jonathan, that it's imperative that there be more supply in the world, especially of energy.
David, what's the likelihood of that happening anytime soon? Are these real suggestions that we can actually act on, or is it just a warning that this is what we're going to face now for a long time?
There are immense amounts of available, you know, natural gas is a key component of fertilizer and of electricity, cleaner energy for electricity generation, and it's available. It just needs to be announced, and the markets are forward looking. So if you announced an intention to have more supply now, it would affect prices immediately, but we've seen that that's not happening. Oil prices are way up. I don't know today, $119 a barrel, and so that's showing you that there haven't been announcements of supply, and I don't see that the governments are making steps on that. Canada did announce an ability to increase supply. I think Mexico and the U.S. could increase supply substantially, and Europe itself has energy reserves that they could be tapping, but so far it's not happening.
David, you took us to clean energy, so let's go there. The FT reported recently that the Treasury sent you a letter, sent the World Bank a letter, asking you to increase your efforts to fight climate change and provide what they called more forceful and constructive leadership. Can you confirm that you received that letter, and can you talk to me about the content of it?
Yes, there was a letter. It was sent in March, so I don't know. The FT is digging deep into its reserves. They mentioned a UN criticism that was done way back in 2021. There's lots going on in the world that I think would be a better focus. The U.S. government has been strongly supportive of the World Bank and what we're doing here. That comes out at every meeting, and it shows in the support from the appropriations process of the U.S., the bipartisan nature of the support for the World Bank. The reason is because we're doing a lot on climate, and I wish the FT would ask what you're doing and what others are doing, and recognize the World Bank has a strong focus on actually reducing greenhouse gas emissions by countries and having impact through careful spending. There's been this big movement in the world just to spend more money and not worry about whether it's having any impact, and greenwashing. We've worked to get away from that, and that's made some of the lobby. There's a big lobby for greenwashing, so they're not happy when you talk about impact. But we're going to keep doing it and keep making progress on cleaner energy. That means a lot more natural gas supply, and that's critical for future global growth because it holds down prices.
David, I'm trying to work out if you're more annoyed with the FT for publishing the piece or with the Treasury for sending the letter, but I haven't got time. David Malpass, great to catch up with you, sir. Thanks for joining us this morning. David Malpass there of the World Bank. Let's get to it in this equity market. Looking ahead to an ECB on Thursday, looking ahead to a CPI report on Friday, with an equity market looking a little something like this on the S&P 500. Equities lower by 0.4%. From New York City, this was the countdown to the open. This is Bloomberg.